Assalamu alaikum wa rahmatullah. My brother Rehan.
Assalamu wa rahmatullahi wa barakatuh.
Jazakallah khairan for your time last week to help record the first ever episode of our podcast, the Halal Investors Podcast. I'm just going to kick it off straight away and continue on from what we discussed last week, which is around the closure of the Silicon Valley Bank. And as you rightly predicted last week, the Fed did step in to help rescue or at least guarantee the depositors' funds. So can you just elaborate a little bit more on what's happened since they've stepped in to now?
Mm-hmm.
Including, just to add on, including the closure of the bank in Switzerland, which if you can, maybe touch on whether it's related to this in any way.
Okay. Yeah, inshallah. Bismillah. Salatu wassalam ala Rasul sallallahu alaihi wasallam. So a lot has happened since, it's only been a week and a half, but there's been an incredible series of events that have unfolded. So Silicon Valley Bank, obviously at that point, had been seized by the FDIC. The FDIC came out and then guaranteed all deposits in Silicon Valley Bank. There were other banks that also failed after that, and right now we're speculating whether First Republic will also go down. It's looking highly likely. So a few things have happened since after the regional banking crisis that's happening in the United States. People are moving a lot of their funds out of smaller banks into the big four in the United States because they're considered too big to fail, and so they kind of have an implicit guarantee from the government. So a lot of people are moving funds into there, but those banks don't, their deposit rates aren't anywhere near what the Fed or what Treasury bonds are yielding, right? Because of the interest rate being close to now 4.75%, close to 5%. So, there is, as people are reconsidering where they bank, they've also started to look at where is the best yield, right? So the banks were been on kind of a good thing where the cost of deposits has been really, really low. So that they could stay profitable by paying very little interest on deposits and earn a lot more interest on their loans, right? Or on the even treasuries that they're holding. So they were making some money. And now that there's a huge pressure on to retain deposits, and the only way that they can retain deposits is by upping the interest rate on the deposit, which means that then they make less of a spread between what they lend and that. So that's it. There's a huge pressure on banks right now from a profitability perspective.
But I guess it's more enticing. They're trying to entice people to keep their deposits in the
system.
Bank.
Yeah. And obviously there's a lot of fear around contagion. Right? And so we saw Credit Suisse, which is, one of the top 3 banks in Switzerland, get into a lot of trouble. Now, Credit Suisse has a long history of getting into trouble. They've been fined many times for various... So they weren't particularly the best bank. And so during this kind of crisis, we've seen them go under. And then the Swiss National Bank has moved in to try and... The first step is always to get a solution from the private markets. So they wanted... UBS, which is the strongest Swiss bank now, to step in and basically consider buying Credit Suisse. And so that deal ended up happening, but at a huge discount, right? So they bought them for around 3 billion, I believe, Swiss francs. It's a $3 billion deal, and that was much less than obviously the market cap of Credit Suisse even a few days ago, right? So it was around 8-9 billion. So at a huge discount they bought. They also, when they did that, and it was basically a forced deal by the government, you can tell they didn't want to take on, you never want to buy your competitor, right?
Yeah.
It's like they were number one competitors of each other, and now they're forced to take on a bunch of potentially really bad assets, right? So the Swiss National Bank has come in to backstop that, say, all right, we guarantee 100 billion, so that UBS doesn't have to wear potential losses as part of acquiring all the assets. Because when you acquire a bank, especially if it's a failing bank, you acquire all their debt.
Yep.
Yeah. So and if the assets go are no good because no one wants them, then you're not able to service that bank's debt, right? Their liabilities. Yeah. So the Swiss National Bank came in. So now you've seen kind of that unfold. The credit default swaps for Credit Suisse before they went under kind of went to the moon, right? And so a credit default swap is insurance against default.
Okay.
Right? Of your counterparty, right?
Right.
So
yeah.
So you buy that kind of like you think of it like an insurance against default.
In case the person who took the loan can't pay it off.
Back, yeah.
Yep.
So you buy these default swaps. Anyway, so there's if the cost of your default swap is high, that means that the market is saying that there's a very high chance of you defaulting. That's why the price is high, because they don't want to. They consider it a likely outcome.
Yep.
Therefore, the cost of insuring against it will be much higher.
Right. Yeah.
Yeah. And so, Credit Suisse's credit default swaps kind of just went vertical, and then they were bought out. Right. Cool. Now UBS's CDSs have kind of gone vertical. So that's the market basically saying, we think UBS is now higher risk of default than it was
maybe
before.
Because they took
because they've taken on that debt, right? And so it's an interesting series of events. So you can see the market trying to send some signals in whether there's confidence or not in the banking system. So that's one thing. Obviously, US banks from an equity perspective have been falling.
Are those two linked in any way, or is it just coincidence that this happened at this time?
Yeah, they aren't directly linked. They're two separate entities and quite far removed. So, but when you have like systemic events like obviously interest rates rising as fast as they have, there's gonna be failure, but you don't know where until it happens, right? Okay. So it's just the first ones that were the unfortunate ones that were either did some bad asset management. Took on too much risk, and then they're the ones who get exposed first when things become tight, right?
Yeah.
So people wanted to get out. Now you can see that the SVB banking that sparked the banking crisis, you could say, or crisis of confidence in banks.
Yep.
Right. Obviously, then people are going to pull money out of any institution, any bank.
Yeah.
Yeah.
There's a lot of confidence.
Yeah. That they think might be a little bit shaky. Yeah. So Credit Suisse always had a dodgy reputation, right?
Okay.
And then, their biggest single investor, right, that owns almost 10% of Credit Suisse was the Saudi, I think it was Saudi National Bank, right?
Okay.
So, that's interesting. So anyway, they said it rightfully so, but it was taken out of context in the sense that they said they're not going to put any more money into Credit Suisse.
Yep.
They said that because they're not allowed to own more than 10%.
Right.
If they do, it becomes a problem because there's a lot more regulatory scrutiny for them owning more than 10% control of a company. So they were at their limit. They were at 9.9%. And so the Saudis said, no, we're not going to put in any more money.
Yeah.
Right. But the market took that as a signal as that they're, there's no confidence. Right? Yeah. That's really what the market read it as. And they said, oh, well, if your biggest investor is not going to put money in, I better take my money out.
Yeah.
You know what I mean? Yeah, so it's interesting signal. So anyway, everyone's on edge right
That's
now.
what I was thinking. There's this fear factor going around, and any negative event is now playing into that fear.
Correct. And so a lot of people now looking at the balance sheets of all US banks and seeing what exposure they have to these these losses that they're unrealized losses, but they're potential losses if you have to liquidate those assets. And the only reason you would have to liquidate those assets is if your depositors also took their money out. Right?
Bank run, basically.
Basically, right?
Okay.
So people are evaluating banks saying, okay, the bank is good, it's fine as it is, but historical models of how many deposits normally come out of a bank and how many come in and so on have been basically made redundant, useless, right, at this point in time, because we're at a point where there is extreme flightiness from a depositor perspective. Yeah?
Yep.
So because there's so much flightiness from a depositor perspective, you can't really just look at a bank and say, oh, this is how many deposits they've got, and they've got more than enough assets to cover that deposit base. Because that deposit base can vanish very, very quickly, and there's no obligation for them to stay with you.
Yeah, exactly.
So from that perspective, I think people are, I guess people who are optimists are looking at banks and saying, look, the bank's fine. These banks are perfectly good.
Yep.
Healthy balance sheets, all of that. They don't have to take those losses because, they've got more than enough capital. And then, I think the uncertainty in the market is, well, if there's any negative news about a bank, the depositors will know, and it's the depositors obviously that have a large amounts of money in these banks, right?
Yeah.
So if you have more than $250,000, so that's why you've got this kind of uncertainty, and basically the use of the Federal Reserve's discount window. So they have a window which is where banks go when they can't get money from anyone else. It's called So basically, because the Fed is the lender of last resort. That window's always been there.
Okay.
But it was always a shame to use it because it's a public record. So if anyone goes and uses it, public finds out.
Yeah.
And then that in and of itself can mean what's wrong with you.
Yeah.
Right?
Yeah.
But right now it's basically insane amount of usage of that window. And then there's also the second to last resort, which is the Federal Home Loan Banks as well. So that's another window that's getting completely smashed by banks, right? In the sense that they're using this in anger. And in the past, I think 2 weeks, they've used as much as they did in 3/4 of the previous year, that Federal Home Loan Bank. So you can see there's a huge spike of banks trying to get loans from these facilities. Okay, what does that mean? It means the private markets, which is where banks normally get lending from. Banks borrow money all the time, right?
Yep.
So there's overnight markets, all this. That means all of those private lending markets have seized up. The banks aren't trusting each other.
Okay.
Yeah.
Yep.
So that's really what it means. If your peers aren't lending to you and you're not lending to each other, then there's a problem.
Yep.
Yeah. And that's when you go tap the Fed's discount window, right? So that's what we're seeing now as it plays out. So it's telling, for me anyway, when I see that, I say it's telling that there is a huge liquidity crunch happening right now, and banks aren't able to get the liquidity they need from the normal functioning markets.
Yep.
Yeah. So interbank lending is dying at this point in time because people don't know who to trust. People don't know. You might be good for the money today, but I don't know a week's time, a month's time, if you're going to be one of those dominoes that falls next. Yeah. Right.
Yeah.
And so that counterparty risk is now being considered too expensive to lend into. So now banks are going to the Fed, the lender of last resort, or the second lender of last resort. They're going to do that right now. So, and that's increasing at an alarming rate, right? We also had the MOVE index. So for stocks, we have something called the VIX, which is the volatility index, basically. And it's obviously, it spikes whenever there's extreme volatility in the equity market.
Okay.
And for bonds, we have something called the MOVE index. And obviously bonds aren't very volatile instruments. But the MOVE is, at this point in time, much higher than the VIX.
Okay.
And it is as high as it was in the GFC.
Okay.
Already, right?
Okay.
So...
And we haven't hit a recession.
We haven't, we haven't even begun, right? So, but it's obviously telling you that when you have volatility in bonds, like a lot of bad things happen because it's like so many standard deviations out of people's normal operating models and risk models.
Because it's supposed to be one of the safest.
It's supposed to be stabilized, and it's not supposed to move that quickly. But because people are rushing out of deposits, for example, and buying treasuries, that means their price is going to go up in a dramatic fashion, right? So they're buying short-term treasury, they're selling long-term, buying short-term, for example. So they're doing a whole bunch of stuff in order to kind of a flight to safety. At the same time, Bitcoin is also on a run.
So I was going to ask you, we saw, last week, gold and Bitcoin kind of just surge up. Is that just a direct effect of the Fed stepping in, or is that just a secondary effect?
I mean, we can only speculate, right? So obviously gold is, in times of uncertainty, a safe haven asset. So we all know this. So people are probably upping their allocation of gold because they want to diversify and escape from the risk that is in the banking system. So you might have some deposits, or you might be sitting on a bunch of cash and you're like, you know what, some of this I'm going to park in gold, right? It's just a hedge. Gold is a hedge against, inflation over the very long term, but it's also a hedge against any particular monetary system, right? Because it's like a global hard currency. The other global hard currency or potential currency is Bitcoin, right? Because you can't change its supply. It's very hard to change the supply of gold. It's very hard to change the supply of Bitcoin. So it's very hard to manipulate in that sense. But obviously there's people who manipulate the price by pumping and dumping. But, there is, I think, the use of Bitcoin also as a hedge against the conventional financial system right now. So it is in a way a diversification, and they're doing that to try and protect from losing all their wealth if a bank closes, if a bank shuts down, you're right, or the Fed doesn't guarantee the millions you have in the bank. So I think Bitcoin has changed its role at this point in time. Obviously, when we were in the boom, the COVID boom, and there was a lot of obviously loose money, and that Bitcoin was behaving like a risk-on asset. So it was where people were going to get even higher potential return because it was a risk-on environment. You couldn't get anything out of holding cash or treasuries. It was like basically zero interest environment. So people were seeking yield, and so they went to Bitcoin because it's the future. It's crypto, right? So it's a fintech. That's what Bitcoin is. And so, but now Bitcoin is, I think, playing a completely different role. It's playing the role of a hedge against a monetary system that's looking very, very risky or unstable, because banks are, like the bedrock of the financial system and the dollar system. And so that's also happened. So it's interesting times where gold and Bitcoin are now correlated to some degree again. And
this instability that you mentioned, for the past week or so, where banks don't trust each other and there's this fear rising, is it trending upwards in terms of getting worse, this distrust, which, again, will just snowball into something much, much bigger? Or do you think maybe the trend is going to buck or is bucking, and maybe we see some sort of confidence returning back into the system?
Yeah, I think, look, these things happen over an extended period of time. And so you'll find that there'll be periods where you have crisis, like now it feels like a crisis, and then in between this and the next domino falling, it feels like everything's normal. Right? So there will be a return to that well, nothing's breaking
anymore,
and everyone's like, everything's back to normal. But in the background, the next thing is lurching, right? And you'll notice when it falls, right? And so then the next domino will fall. So at this point in time, well, if you're looking at the MOVE index, if you're looking at how much money banks are borrowing from the Feds, as a lender of last resort, how much they're getting out of the federal home loan window, how much they're getting also, like the swap lines that have been coordinated. So global central banks, like some of the biggest central banks in the world, obviously the ECB, which is European Central Bank, the United States, Bank of England, you've got obviously the Swiss Central Bank, so a whole bunch, Bank of Japan, like a whole bunch of global significant central banks have now this coordinated access to Federal Reserve's swap lines for dollars. Now what that is, and they're doing these auctions for dollars on a daily basis now. So before it was weekly, that was there. They I think in the GFC they opened up that program to allow the Fed to provide dollars to international banks, because when central banks of other countries need to lend dollars, right, they have to get it from the Fed. So the Fed opens the swap lines, but now that's been increased over the weekend to a daily auction, right? So again, that's a bit of a warning sign when all of these central banks preemptively do this, for you to say, oh, well, there's no contagion, everything's all right. They're obviously preparing for there to be a bit more fallout, so that they can deal with the fallout very quickly, right? Because there will be a shortage of dollars, right, in the global system, especially when all of this is contracting. So that's what's that's another kind of warning sign that I would say is, the more like these central banks, especially the Fed, do something to show you that we've got this, the more it signals to the world that you ain't got this. Because you had all these tools and power before this event, and the fact that wasn't enough, and now you've got to invent these new tools and these new facilities, means that something is not all right. I mean, that's how I read it anyway. So it's all happening in the background.
Are any of these lessons learned from the GFC that they're now preemptively trying to deploy early on to prevent?
Absolutely. So like, when we see these swap lines, definitely that's a lesson learned from the GFC, and they're obviously just deploying it earlier, so that if there is a crisis, or when there is a crisis, it won't be as prolonged, because there'll be a mad rush for dollars, for example, and they're ready to issue those dollars, right? So those current foreign currency swaps. So absolutely lessons learned, and I think they're acting more proactively at this point in time, and that does give a lot of people a bit more confidence that if there is a crisis, that something will be done about it.
Awesome. And I guess the next question is more, I guess, again, just for our listeners, not financial advice, what we discuss here, but I guess on a more personal level, what is it that you are looking to do to navigate your way through these times that we don't even know, how long they may last?
So, I mean, I think we're going to be looking very closely at which trends change with regards to the assets that we've got, in our signals. So in momentum, obviously, just this week, gold and crypto went bullish. Right? So we're definitely, in those trades, but we'll be very careful to get out when we see any sign of trouble. So our stop losses in that will kick in. So from that perspective, we're going to navigate this very tactically, right? So, and we're going to stay in cash, right, until it's clear that certain asset class is going bullish. We'll go in carefully, and then we'll, hopefully ride the momentum of that, and then get out as soon as that momentum kind of turns direction. And I think that's the only way that you can ride this. There will be rallies of different different assets, that might be short-lived rallies, and we'll try and catch those. But other than that, we'll be out of the market based on our short-term momentum strategies. And so that's how we're looking to play kind of the current crisis.
What about from a long-term set and forget strategy? Because I know Halalstocks has two product suites. One is a short-term, one is a long-term. So it's good, I guess, to see how the short-term can still take advantage of the current market situations, albeit a bit more carefully. From the long-term point of view, is it still, I guess, for people who have different strategies for diversification, can they still DCA into the market and just be like, okay, if it's crashing, things are getting cheaper, I don't care, because I'm just going to DCA into it, and then I'll reap the benefits when the market recovers, which it traditionally has over different periods of time, but usually it bounces back a lot stronger.
Yeah.
Do you still think that has a part to play, or is it safest just to stay out for now?
Yeah, I mean, if you're worried about, and I mean, the way I'm looking at this is not financial advice, but the way I'm looking at it is, if I'm worried about the balance of a particular account, let's say it's not my retirement account, right?
Yeah.
So if I'm looking at an investment account that I have that's short term, that I may need to use these funds, next year or this year or even 2 years from now, and then I wouldn't be using those funds to be DCAing into, deploying into a long-term equity strategy.
Okay.
So I think in the short-term, equities will rally until some bigger cracks appear. So the credit crisis haven't started yet. So we've been anticipating a credit crisis.
Yep.
Because that's in the making. It's that's the collateral damage. It's like the milestone that you have to reach on the way to fighting inflation.
Yep.
Is you need some borrowers to go to default, basically.
Unfortunately.
And that's that money disappearing from the system. That's what happens. Because you got to understand, credit is money, right? So the Fed is obviously trying to do that. When they jack up interest rates, part of the milestones of that process, even though they'll say it's not intended, may not be your intention. Your intention is to reduce inflation.
Yeah.
But you well know the milestone, the path that you have to cross is that a whole bunch of people are going to default.
Yep.
And lending will become restricted, right?
Yep.
And that's the pathway to reducing basically the money supply.
Okay.
Yeah. So I think on that pathway, equities will rally a few times, especially if there's any hint that the Fed will change course. But I think the Fed will change course when it's doom and gloom and a whole bunch of really bad things have happened that will remove confidence from the market. So right now, Amazon is letting go of people. Microsoft's letting go of people, right? So all of these big, very profitable companies are letting go of people, right? So they foresee that spending is going to go down, which means their income's going to come down.
Yeah.
And so when incomes come down, earnings come down. When earnings come down, the stock market typically has to go down, right? And so because that's how stocks are valued, on earnings. So that's the process that we'll go through. So there is more downside for the equity markets as a whole to come, right? As they eventually, as the credit crisis rolls through, people can't borrow money to pay for things that they buy from companies. So that will restrict how many sales they make, and that filters down into earnings, which then filters down into valuation, which causes the market value to drop, right? So I think that's still yet to play out. So from that perspective, you can still DCA through it as long as you've got like a 5-year horizon.
Or like a retirement fund. That
it's like 10, 20 years. Because then you will catch the bottom. That's the reality of it. And so when you do that, you'll come out the other side of it when the Fed has decided, okay, enough's enough. Inflation's dead. Now we have to stimulate the economy because the economy is on life support on the ground, right? Basically, it's laying sideways. It's dead. So the Fed will come in then and start to stimulate, and then we'll restart the cycle. But that may be a year or two out. You know what I mean?
Okay.
Right now the crisis will definitely make the Fed rethink, so they might pause. But until they see those lagging inflation indicators come down,
Yeah.
that's their free pass. Once
Okay.
those come down, they'll be like, all right, job done. Thank you.
Okay.
Pats on the back. And now you can go back to maybe lowering interest rates a little bit,
Yeah.
you know, maybe bring them down to 3%, you know,
Yeah.
like, and try and get the market started again.
Okay.
Yeah.
Okay. Jazakallah khairan. I think, yeah, we've just crossed half an hour mark, so I think it's a good time to end today's session. Inshallah, what I want to do in the next session, because we touched on it a little bit today, is just the product suite of the momentum versus long term, and just delve into those a little bit deeper and just pick your brains on those two in the next episode, if possible. And obviously, any I guess modern day situations that have happened, or any updates to the market,
Yeah.
or events that have taken place between now and then.
Yes, inshallah. So
Inshallah.
tomorrow, I mean, we're recording this on the day just before the next interest rate announcement from the Fed. So that'll happen tomorrow.
Okay.
And so, and it's also the day before the first day of Ramadan. So quite interesting times. You know, we would predict that what the Fed does is raise rates by 25 basis points. That's like the base case. You'd expect them to try and be hawkish, but you know, tell people that you know we're absolutely focused on financial system stability as well, right?
Okay.
So that people don't think that these guys are just gonna bulldoze through the banking system.
Yeah.
And so, yeah, I think that's what's probably gonna happen tomorrow. So it'll be an interesting meeting, and you know, there may be a bit of buy the rumor, sell the news kind of thing happening tomorrow
Okay.
as well. So once that what is predicted will come to pass, there may be a bit of a sell-off, but who knows, right? So we've got our kind of stop losses ready to
Yeah.
cover the case where if the market sells off. Otherwise, we'll ride it to new highs, inshallah.
Inshallah. Jazakallah khairan, Brother Rehan, for your time, and to our listeners for listening. This is the start of, inshallah, a long series of podcasts. So please subscribe to our channel and send through any feedback, questions, suggestions, any topics that you want us to discuss. And, you know, we'll be sure to do that in the upcoming episodes. Assalamu alaikum wa rahmatullahi wa barakatuh.
Wa alaikum assalam.